How is everyone doing? Welcome to the Strategy Room on this Friday night, June 27th, 2025. I hope everybody's having a great night tonight. I have got a ton of stuff as usual. We got a jam-packed night. We got a lot to go through, a lot to kick off here. So I am going to jump right into it. Obviously, all the news this week, Jeremy Powell testifying in front of Congress on Tuesday and Wednesday, kind of taking a beating there in front of Congress and then taking a beating from the president to boot. But let's jump in. The first article here, Powell emphasizes the Fed's obligation to prevent ongoing inflation problem despite Trump criticism. So the Federal Reserve, Jeremy Powell, on Tuesday said he expects policymakers to stay on hold until they have a better handle on the impact tariffs will have on prices. However, some of his policymakers are starting to disagree with him, which we'll get to in just a second. The cautious tones could further antagonize President Donald Trump, who has ramped up his longstanding criticism of Powell. Yes, that is a 100% guaranteed happened. Powell will present his speech along with the Fed's monetary policy report first to the House Financial Services Committee on Tuesday morning, then the Senate Banking Committee a day later on Wednesday, which he did. And we'll keep rolling here. So and that leads to Trump's relentless Fed pressure creates lose-lose scenario for Powell. So two Fed officials appointed by Trump have become the first to speak out in favor of lower rates after having supported last week's decision to hold them steady. Now, I would tell everybody that this got kicked off last week by Bill Pulte, who is over at the Federal Housing Finance Agency, the FHFA. Bill Pulte basically started going ballistic on X and just, tweeting up a storm. Jeremy Powell needs to lower rates. Jeremy Powell needs to resign. Jeremy Powell just doesn't get it. He's losing touch. He's killing the housing market, on and on and on and on. Then on Friday, you had Fed Governor Waller got up on CNBC and basically just let him have it and said, yeah, no, we need to cut rates, and we probably need to cut rates as soon as, wait for it, the July meeting next month. Then on Monday, you had Mickey Bowman, basically another Fed governor. She came out and basically said on Monday, yes, she concurred with Waller that, yes, we probably need to reduce rates sooner rather than later. And she wouldn't be opposed to cutting rates as early as July either. So, we've definitely got there is definitely a shifting of the commentary and the political dynamic here. So, but let's see what else is. So President Trump is pressuring the Fed to cut rates with a public barrage that has few precedents in modern history. Trump wants the Fed to cut rates to below 1% and 2%. To lower the cost of servicing the federal debt. The Fed worries about being perceived as politically motivated, which would undermine the ability to manage the economy. They weren't worried about being politically motivated last year. They're just worried about it this year. Just this year. I'll let you fill in the blanks there to figure out why. So President Trump escalated his long-running public attacks on the Federal Reserve, creating a lose-lose situation for the central bank as it navigates the risks of higher prices and weaker growth from tariffs. The assault has little modern precedent and forces the Fed to confront a dreadful choice. It could cut rates sharply, as Trump demands, and risk fueling inflation. That damages its credibility with markets, or it could maintain its current wait-and-see stance and face further bullying that would weaken its standing if the economy slows sharply and the administration is validated in its view that inflation shouldn't be a worry. The presidential pressure is being applied at the same time that a divide is opening up among Fed policymakers that could further complicate Chair Jeremy Powell's efforts to balance political and economic hazards in the months ahead. Among Fed officials who have spoken since last week's meeting, the first to signal any appetite to cut rates at the Fed's next meeting in late July have been the two appointed by Trump in his first term. Michelle, otherwise known as Mickey Bowman, the Fed's vice chair for bank supervision, like I said, and Fed Governor Christopher Waller, and like I said in the CNBC interview. Powell faced Congress on Tuesday, which he already did. But so basically, Powell is under a relentless assault at the moment. And I think deservedly so. But let's look at a couple more things here. So Trump, then later in the week here on Wednesday, Trump considers naming new Fed chair early in a bid to undermine Jeremy Powell. So Warsh, Hassett, and Besant are among those under consideration as Trump evaluates their commitment to cutting rates. Now, I would say if, for whatever my 2 cents are worth, which aren't much, I would basically say that the person that I would feel the most comfortable with would be Besant. I think Besant has proven himself to be a very good Treasury Secretary thus far. Still has a long way to go, but I think thus far, first few months out of the gate, I think he's doing a very good job as the Treasury Secretary. So if Trump decided to appoint him as the next chair of the Federal Reserve, I would not have any issue with that. I think he could do the job, and I think he could do the job very well. But I digress. Let's go. So President Trump is considering announcing his pick to succeed Fed Chair Jeremy Powell earlier than expected. Kevin Warsh, Kevin Hassett, and Scott Bessent, David Malpass, and Christopher Waller are potential candidates. Now, don't forget what I said last week. When Waller went on CNBC, I basically said that, hey, that is his job interview. He's throwing down the resume on the desk, and he's telling the president, "I'm your guy. You put me in, I will cut those rates, baby." So no doubt, last week, Christopher Waller's interview on CNBC was his interview for the job, no doubt. An early announcement could let the chair in waiting influence investor expectations about interest rates. President Trump's exasperation over the Federal Reserve's take it slow approach to cutting interest rates is prompting him to consider accelerating when he will announce his pick to succeed Chair Jeremy Powell, whose term runs for another 11 months. In recent weeks, the president has toyed with the idea of selecting and announcing Powell's replacement by September or October, according to people familiar with the matter. One of these people said the president's ire toward Powell could prompt an even earlier announcement sometime this summer. Trump is considering former Fed Governor Kevin Marsh and National Economic Council Director Kevin Hassett. According to people familiar with the matter, Treasury Secretary Scott Bessent is being pitched to Trump by allies of both men as a potential candidate. Some of these people said other contenders include former World Bank President David Malpass and Fed Governor Christopher Waller. Because the new chair wouldn't take office until next May, announcing the pick this summer or fall would be far earlier than the traditional 3 to 4 month transition period. An earlier announcement could allow the chair in waiting to influence investor expectations about the likely path for rates, like a backseat driver attempting to steer monetary policy before Powell's term ends. Yes. So I think that appointing a Fed chair, in the summertime here or in the next month or two, I think that might be a little much. But I think you have to put a huge but on this. Jeremy Powell's got, he basically has about 10 months left until he's done in May of next year. So, and like I said, normally it's customary about 3-4 months before somebody leaves, you're going to appoint the successor, you're going to put them in and basically give them a transition period. That would take us to probably about February of next year. I would say if Powell does not do, my thought would be if Powell does not do something by the end of September. So remember, you don't have a meeting in August. So you have a meeting in July, no meeting in August. When I say no meeting, I mean the FOMC, Federal Open Markets Committee. There's an FOMC meeting in July. There's no FOMC meeting in August. And then they come back and they have the meeting in September, usually around September 17th or 18th. I would say if there is no movement by the end of September, you're probably going to see Trump go ballistic, and he probably will appoint the successor and basically put him in there and basically just say, go stir the what storm. Get in there and just basically get up Powell's butt basically, and we're basically gonna make the last 5 or 6 months of his term a living what. That would be my guess. So this is all very interesting. And like I said, I think Powell is basically on borrowed time at this point. I think he's got a few months left to try to basically do something. And again, all he's got to do is bring the rates down. He brings the rates down a little bit. And again, I don't, I've said before, do I think rates need to come down 2 basis points? No. I think if you, or I'm sorry, 200 basis points rather. No, I think the sweet spot is somewhere between a point to a point and a half. So, if Powell came out and basically said, all right, here's what we're going to do. We're going to cut by a quarter point, and we're going to do that, every meeting for the last, 3 meetings of the year. So we're going to do September, October, and December. We're going to come out, we're going to cut 3 times before the end of the year, 75 basis points. And then, next year we may cut another, 50 to 75 basis points. We'll play it by year and kind of see where we're at. If he came out and did that, I think, again, Trump would immediately stop riding him, and he would just, and then Trump would go off to focus on other things. But again, if Powell wants to be stubborn, he doesn't want to do it. This is good. This is the game plan. This is what's going to happen. He's going to get ridden right out of there. All right, let's see here. Let's talk about some trade stuff here for a minute. So obviously this is kind of breaking news. This just happened 4 hours ago, 5 hours ago. Trump ends all U.S. trade talks with Canada over digital services tax. So President Donald Trump said the United States is immediately terminating all discussions on trade with Canada. Trump said on Truth Social that he made the decision in response to Ottawa imposing a digital services tax on U.S. tech firms. We will let Canada know the tariff that they will be paying to do business with the United States of America within the next 7 days, within the next 7-day period, Trump added. So, yes, things not going well with Canada. I just cannot believe this on the part of Canada. I mean, I just think that this is just incredibly stupid on their part. We subsidize Canada to the tune of $250 billion annually. They don't get that money from us. They're in trouble. Furthermore, I've showed in a number of maybe even a couple months ago, probably a couple months ago now, I showed some charts basically showing the tariffs that we were getting from Canada on some of our products. We had some of our products, just basic stuff, milk, butter, getting 200 and something percent tariffs, 300 and something percent, 400% tariffs. I mean, it was crazy. The percentage of tariffs that we were getting hit with from our friend Canada, who's basically like, if that's a friend, I hate to see your enemy, because if they're killing us with tariffs and we're paying them $250 billion a year to kill us with tariffs, that's not much of a friend in my humble opinion. That's not much of a friend. So I'm not shocked by this. I cannot believe that Canada is this stupid. I don't know what they're hoping to achieve. They're going to get cut. Trump's going to cut off that $250 billion. That's for sure. That's going to get cut off, and their tariffs are going to get jacked up, and their economy is going to go into the toilet. So they need us. We don't need them. I've tried to explain this. Same thing with Mexico. Mexico needs us. We don't need Mexico. They need us. Canada needs us. We don't need them. It's like, again, Mexico kind of, they kind of got the message. It came around real quick. Canada seems like they need to take some economic pain before they get the gist of that they don't have any leverage. Let me say that again. Hopefully some people in Canada will hear this. You don't have any leverage. None. You have zero. So I don't know. Okay. China confirms details of U.S. trade deals. So China says it will review and approve eligible licenses for items subject to export control rules. The U.S. will correspondingly cancel a range of existing restrictive measures imposed against Beijing. The statement said U.S. President Donald Trump said Thursday that we just signed with China yesterday. So the U.S. and China have confirmed details of a trade framework that seeks to allow rare earth exports and easing of tax restrictions, according to a statement released by China's Ministry of Commerce on Friday afternoon. China will review and approve export applications for items subject to export control rules, while the U.S. will correspondingly cancel a range of existing restrictive measures imposed against Beijing, a spokesperson for the ministry said in a statement, without elaborating. The statement comes after U.S. President Donald Trump said Thursday at an event in the White House that we just signed with China yesterday. A White House official later clarified that the administration and China had agreed to an additional understanding of a framework to implement the Geneva Agreement. So, is this a full deal with China? No, I don't think so. I don't think this is a full deal with China. I think I would describe this as the beginning of a larger deal, hopefully, that will be coming down the pike. But this is just I think this is just the first step. It's like the first tranche, if you will. I think the U.S. and China, I would estimate that they pick the easiest things that they could work on. Like, what are the two easiest things that we could work on out of the gate? Some things that we could agree on relatively easily. Both sides can kind of get an early win. That's kind of my view on this. I think the tougher negotiations are yet to come. I think the tougher items are yet to come. I think this is just the preliminary working. This enables kind of both sides to get an early win, feel good about it, make it look like there's progress going in the right direction, all that kind of good stuff. So that's kind of my take on it. Now, here is some more incredible news. So Trump's tariff revenue is on pace for another monthly record in June. Now, I've reported to everybody that tariff revenues basically spiked in April, went up again in May, and now we're going to see even more improvement here in June. So President Trump's tariffs are pouring billions more into U.S. coffers in June, putting the revenue supplied by importers on pace for another monthly record. The latest measure of government receipts for customs and certain excise taxes stood at almost $27 billion for the month of June, according to the Treasury Department's latest daily statement dated June 25th. So almost $27 billion for the month. That is fantastic. The monthly total is likely to rise only slightly in the coming days, with importers often depositing their tariff duties in a single day, and the June 24th statement showing a massive daily deposit of more than $19.9 billion. June's total so far has already topped May's total haul of about $22 billion, not to mention April and March's totals of $17.4 billion and $9.6 billion, respectively. It was a continuation of revenue spikes seen during Trump's second term in office that are dwarfing counts from recent history, as well as amounts collected during Trump's first term. Now, look at this chart. This is beautiful. 30 years of government tariff revenue. You could see here for basically the last 30 years, not much happening. President Trump's first term, you can see here we kind of spiked in, and then it came back down, and then back up, and then back down over Biden's term. And you just look at that. Oh, it's a beautiful thing. Look at that, just straight up like an arrow. We just came in here hovering around 6.8 billion, and now we're up to 22 billion here in May, and like you said, going up to 27 billion this month. All told, more than 121 billion has flowed into government coffers since the start of this fiscal year. Commerce Secretary Howard Lutnick touted the pace of deposits earlier this week in a social media post that criticized Federal Reserve Chairman Jeremy Powell. What he avoids discussing is the incredible revenue increase the U.S. has received from these tariffs. Lutnick said in a post suggesting the U.S.'s current run rate is for more than $30 billion per month. June's revenue totals mark the first month where tariff rates have largely remained unchanged after months of up and down duties early in Trump's second term. And April is an example. Trump's 10% duties on nearly every country in the world began on the 5th of that month. The new data also comes after the Congressional Budget Office, the CBO, projected earlier this month that Trump's tariffs could reduce primary deficits by $2.8 trillion over the coming decade, but with a significant assumption that current duties stay constant and in place even after Trump is scheduled to leave office. So, yes, a lot is going to hinge on whether the next president after Trump will continue these policies. But hopefully, what will happen is that people will see how effective these policies are, how much revenue they bring in. See this, and this is the whole thing. If you've got all this extra revenue coming in, what do you not have to do? You don't have to increase taxes to pay for a lot of stuff, do you? You're also going to bring the federal trade deficit is going to come. You watch in the next 6 to 8 months. I'm not saying it's going to it's not going to go from being negative $1 trillion to getting back to break even. That's not going to happen. But could the trade deficit get cut in half? Could the trade deficit come down to maybe 5, 6, 700 billion, something in that rate? I think it absolutely will. And so you're going to see these revenues continue to go up. And this is the thing. Powell wants to constantly cry about the what if scenario of inflation from tariffs, right? Okay, well, that's fine, but it's a double-edged sword. There is potential increase in inflation from tariffs, but you also have this revenue from tariffs that basically offsetting factors, right? And he just does not want to account for this revenue that's coming in the door. And it's kind of wild watching his testimony, a little bit of it anyway, on Tuesday and Wednesday. Some of the congressmen and senators asking him questions. It's like, well, don't you just take into consideration basic things? And he's just I'm not looking at that. No, I'm not looking at this. I'm not taking into consideration that. I mean, it's just kind of wild because you just basically, like I've said, unfortunately, Powell has taken this attitude of, I liken it to the kid on the playground, when you were in grade school, who's going, hey, I'm taking my, you guys, don't want to do things the way I want to do it, so I'm taking my ball and I'm going home. So forget everybody. If you don't want to play it my way and praise me for it, then I'm going home and nobody gets to play. And I feel like that's just how I feel like he's acting here. So, okay. Enough of that soapbox for the moment. So, okay. This is another big thing that just hit today. Core inflation rate rose to 2.7% in May, more than expected, the Fed's preferred gauge shows. Now, I have to laugh about the way that they wrote this article, right? So what in other words, what they are trying to do here with this article is to give you the impression that, hey, Powell is right. Powell's right. Look at this. Here's our evidence. Here's Powell's evidence right here. Look at this. The core inflation is spiking back up. But is it really? Let's take a slightly deeper dive on this for a minute. So, the Personal Consumption Expenditures Price Index, the Fed's primary inflation reading, rose a seasonally adjusted 0.1% for the month, putting the annual inflation rate at 2.3%. Where does the Fed want inflation to be? At 2%. So it's at 2.3%. Little bit high, or like a little bit over where they want to be. But is that freak out? Like, oh my gosh, the inflation is just spiking back up like crazy. Now, here's the other side of it. Excluding food and energy, core PCE posted respective earnings of 0.2 and 2.7%, compared with estimates for 0.1% and 2.6%. Okay, but here's what I would also tell you. 5 months ago, do you know where core PCE was? I know because I've told everybody when we were on on other episodes here. So core PCE was running about 3.3 or 3.4%. In the last 5 months, it has come down to 2.7% here. So the inflation has come way down in the last 5-6 months. Now, obviously, we saw a little blip up here, and but again, this is not the end of the world. And I would also remind everybody that inflation doesn't necessarily move, up and down every single month. It doesn't just go straight down or straight up. Inflation has a tendency to it has a tendency to bounce around a little bit. So, but again, nothing in here is catastrophic, and nothing in here in my mind proves Powell's point of like, oh, all this inflation is just lurking right around the corner. No. Consumer spending and income showed further signs of weakening. Spending fell 0.1% for the month, while personal income declined 0.4%. So prices that consumers pay rose slightly in May, while the annual inflation rate edged further away from the Federal Reserve's target, according to a Commerce Department report on Friday. Personal consumption expenditures price index, the Fed's, again, primary inflation, adjusted for 0.1% for the month, putting the annual inflation rate at 2.3%. Economists surveyed by Dow Jones had been looking for respective levels of 0.1 and 2.3. And again, like I said, excluding food and energy, the core number was up at 2.7%. So the Fed's targets inflation at 2%, a level where it has not been since early 2021. So I just point out that, like, was anything in here catastrophic? No. But again, this headline was written in a very specific fashion. They wanted to highlight the core number. They wanted to say core inflation rate rose to 2.7%. It's going way above the Fed's 2% rate. We can't possibly deal with this. So no, that's not really right. Okay, the number people should focus in on this report for this month at this moment is the 2.3%. So again, didn't improve, but in my mind, really didn't get any worse. It just kind of stayed neutral for the moment. And and as I always say, 1 month does not a trend make. We need a few more months to see what goes on here. My guess is that over the next 3-4 months, inflation will continue to nudge down. We will see what happens though. Okay. Fed officials could be split on whether to cut interest rates in July. Now, we talked about this a few minutes earlier, but again, just another article pointing out that at least 2 Fed officials spoke out in favor of lowering borrowing costs as soon as July, while several others said the Fed could hold interest rates steady for now. Lower borrowing costs could boost the economy. No, there is no could. They will boost the economy, but may set back the Fed's efforts to reduce inflation to a 2% annual rate. Financial markets are betting the patient faction led by Fed Chair Jeremy Powell will prevail, at least for now, assigning a 22% chance of a Fed rate cut in July. President Donald Trump has repeatedly demanded the central bank cut the Fed funds rate, igniting a debate over whether the Fed, an independent body, should answer to the president. Okay, yeah, I'm so tired of the independent body nonsense. Okay, again, Fed Governor Bowman favors July interest rate cut if inflation stays low. So we already talked about that. All right, so let's kick into something else here for a second. So Fed drops reputation risk from bank exams amid backlash to debanking. So the move aligns with the GOP push to curb financial discrimination and joins similar actions by other bank regulators. So what does this mean before we jump into the article? So what this means is that the Fed goes in and the Fed examines the bank, right? The Fed does an audit of the bank. Well, one of the factors that the Fed had been considering was what they called reputational risk, a very subjective, we don't necessarily like this person you're banking. You might want to rate them as a high risk individual. And if you rate them as high risk, that puts them into a special category. And then you may have to do other things if you want to keep that, to keep in, other things like hold additional capital or do other things, to basically keep that customer. And so of course the bank immediately freaks out and goes, no, we don't want to do that. And now we're going to go tell this customer they need to go. So just to give everybody a little bit more context to what this is all about. So the Federal Reserve announced on June 23rd that it will no longer factor reputational risk into its bank examinations, a move aligned with efforts by Republican lawmakers and the Trump administration to combat what they describe as politically motivated financial discrimination, particularly debanking. The central bank said in a statement that it has begun reviewing and revising its supervisory materials to remove references to reputation risk, replacing them where appropriate with more specific discussions of financial risk. This change does not alter the board's expectation that banks maintain strong risk management to ensure safety and soundness and compliance with law and regulation, the Fed said in a statement. The decision is a significant shift in how regulators assess banks, particularly as scrutiny intensifies over claims that some institutions have denied services to lawful businesses such as cryptocurrency firms, religious organizations, or political groups based on subjective concerns about reputational harm. Although banks generally have wide discretion over account relationships, critics argue that invoking reputational risk can mask discriminatory decisions. These concerns have fueled growing bipartisan calls to ensure fair access to financial services. This is how debanking works, Jeremy Tedesco, senior counsel at Alliance Defending Freedom, told the Epoch Times in a 2023 interview. The bank closes the accounts, doesn't give a clear reason, and cites some kind of risk toleration policy for the denial under circumstances that look very suspiciously like it was because of your religious or political views. Lawmakers have responded with legislation aimed at combating financial discrimination. In March, for example, Senator Tim Scott introduced the Financial Integrity and Regulation Management Act, the FIRM Act, which would bar federal regulators from penalizing or pressuring financial institutions based on reputational risk. A bipartisan House version was introduced the following month by Reps Andy Barr and Richie Torres. Now, I just want to show everybody something as a different, okay, so now here's an article from Banking Drive. So the one article was from the Epoch Times. This is from Banking Drive. So this says, Fed joins OCC, FDIC in scrubbing reputational risk from exams. The central bank said it would replace references to the metric with more specific discussions of financial risk. Banks can still use the concept in their own risk management policies, the Fed said. The Federal Reserve Board has begun reviewing and removing references to reputation and reputational risk from its supervisory materials, including examination manuals, the central bank said Monday. The regulator joins the Office of the Comptroller of the Currency and the FDIC in scrubbing such language from the collective vernacular. FDIC Acting Chair Travis Hill said in March his agency completed a review of all mentions of reputational risk in similar terms in its policy documents and plans to eradicate this concept from our regulatory approach. While a bank's reputation is critically important, most activities that could threaten a bank's reputation do so through traditional risk channels, i.e. credit risk, market risk, etc. That supervisors already focus on, Hill wrote. Meanwhile, reputational risk has been abused in the past and adds no value from a safety and soundness perspective as a standalone risk. Republican lawmakers have led a push to root out reputational risk as a regulatory flag, arguing it has prompted some institutions to debank individuals and companies that lean conservative. So, again, very interesting stuff here. So again, what is really happening here? What are we really talking about? Well, we're just going back to quote unquote normal. The reputational risk, what do I want to say here? How do I want to say that? The category, I'll say it that way, the reputational risk category that was being used as part of a bank examination or a bank review, a bank audit, that, like they said, that category was basically being abused in a number of different ways. And again, was reputational risk something that was traditionally part of the bank audit process? No, it was not. It was something that was just put in a few years ago, and it appears that it was put in for political purposes. And now this is just getting removed, and we're basically just going back to normal. Nothing else is changing. The way that banks have always been audited, reviewed, analyzed, assessed, all of that is staying exactly the same. They're just taking this hyper-partisan, potentially political, very subjective category out. That's what's happening. So in a nutshell there. Okay, now here's another big thing. So there's so much this week. Fed proposes 27% cut to Tier 1 capital requirements. So changes to the enhanced supplementary leverage ratio would be accompanied by a 5% reduction in total loss absorbing capacity and a 16% drop in long-term debt requirements. So what does all that mean in English? Well, Tier 1 capital requirements would drop by 27% for bank subsidiaries of the nation's 8 global systemically important banks under a proposal the Federal Reserve Board issued Wednesday. Fed governors voted 5-2 in favor of the proposal, which would cut the enhanced supplementary leverage ratio, a measure of how much capital banks must hold relative to their assets, to between 3.5% and 4.5% for bank holding companies and their depository institution subsidiaries. That's down from 5% for the former and 6% for the latter. The proposal would also reduce total loss absorbing capacity by 5% and long-term debt requirements by 16%. So the ESLR reduction would free up, and here's the big thing, this would free up $210 billion in capital requirements. And though that represents a tier one drop of more than a quarter for bank subsidiaries, holding companies would see a much more modest 1.4% reduction. Fed Chair Jeremy Powell, in testimony on Capitol Hill, told lawmakers the potential changes are meant to make the ESLR a backstop instead of a binding constraint for banks. Such a move would free banks to trade more heavily in the $29 trillion treasuries market, proponents argue. Skeptics, including Senator Elizabeth Warren, have said easing the ESLR would not free up a pot of money for banks to lend more or buy more assets. Rather, mega banks appear motivated by the short-term benefits of capital deregulation for shareholders and executives, increased dividends, buybacks, and bonuses. Now, I'm going to get to the buybacks in just a second here. I have a very interesting little blurb from the Wall Street Journal that I want to read to everybody here in a minute on buybacks. Warren wrote Monday in a letter to the vice chair for supervision, Michelle Bowman. Bowman said in a statement on Wednesday, basically asserted the proposals change at the bank level do not enable them to increase capital distributions to shareholders, as their holding companies would generally remain constrained by risk-based capital requirements. Absolutely, 100%. Further, GSIB holding companies are required to contribute assets to their bank subsidiaries to cover capital shortfalls, she said. However, Fed Governor Michael Barr said Wednesday's proposal overestimates the expectations that holding companies serve as a source of strength to their banks, citing Silicon Valley bank's failure in 2023. Barr and fellow Governor Fed Adriana Kugler were the two officials who voted against the proposal. So, but here's the thing. And I think this is the big thing here. Such a move would also free banks to trade more heavily in the 29 trillion treasuries market. Yes, this is what they're looking at. They're basically saying we want banks to get out there and buy more treasuries because we need help in the treasury auctions. So I think long term, I think this is a very good thing. Will it ultimately help in terms of putting a lot more money back out on the street? It will a little bit. I don't think it's gonna make this giant colossal impact because you're only reducing it a little bit. But the key thing here is that it's going to allow banks to buy more treasuries. And that's going to help the government in terms of the flow and the function of the treasury market and all the treasury auctions and selling our debt. That's going to be a big bonus out there for doing this. And plus, it was too high to begin with. I think it was too high to begin with, and they didn't make. Again, you're not making major reductions here. You're trimming this back a little bit. Again, banks must hold the measure of how much capital banks must hold relative to their assets to between 3.5% and 4.5%, which was cut. That was down from 5% and 6%, so again, you're cutting it back, but it's not like you're taking it to zero, right? They're still holding capital. And this idea from, again, Elizabeth Warren, I swear, I think that she just wants banks to hold every dollar they have in capital. And how does that benefit you? Banks are in the risk business. Okay. Now, what does that mean to be in the risk business? It means that the banks take very calculated risks. They take very calculated risks. In other words, they lend the money out on what they hope to be are really sound, strong loans. They do. Again, this is why, you don't venture into certain risky industries. You probably don't lend a lot of money to startups. You run a good portfolio based on existing companies that can show cash flow and have collateral. And that's how you build very strong loan portfolios. So you're taking very calculated risks. However, you're still in the risk of business. You still have a lot of risks. You have liquidity risk, market risk, credit risk, operational risk, reputational risk. I mean, it just goes on and on. There's tons of risks that banks have to deal with and have to mitigate. So again, you're still managing risk here. You're still managing risk here. You're still keeping a buffer. It's just that the buffer was perhaps getting too large, and you're just trying to reduce that a little bit. So I think this will be a good thing. Now, let me switch gears for just a second here. I want to read everybody something I thought that was pretty interesting. This was from Tellis Demos, who is a journalist for the Wall Street Journal. Tellis has written a lot of great stuff over the years. I've probably read hundreds of his articles over the last 10 years. Very good, very good on bank stuff and bank items. So let's address the buyback thing for just a second. So big U.S. banks could go on a stock buyback spree, but should they? Buybacks sometimes get skeptical looks from investors. What? There wasn't a better use for the money? Not so for banks. In the years since the 2008 financial crisis, when banks had to raise tons of new capital, many investors have been salivating to get it back. The Federal Reserve's annual stress test due later today. I'll spare everybody the surprise. All the stress tests came back. Everybody passed. Every bank passed. Nobody failed. Everything was good. So, but not to digress, are a big event for buyback boffins. It's a good word there, boffins. They reveal how much additional capital a bank needs to stay above minimum regulatory requirements in a worst case scenario. Anything beyond that is, to some shareholders, ripe for return. That future excess could grow too if several tweaks under consideration by banking regulators are adopted. Large banks tracked by Barclays analysts could see their total above target capital go from about 80 billion to nearly 140 billion, the analysts estimated in a recent note. Banks have long highlighted a profit metric that benefits from capital returns, return on tangible common equity. This measures net income as a percentage of equity capital. Less equity as a result of buybacks means the same profit delivers a higher return per share. That can reward lenders who do less, lending. Many loans require a lot of capital in case they go bad, but many fee businesses like managing money or advising boardrooms don't. For a while, this was a sensible shift. Investors wanted banks to take less credit risk anyway. Near zero rates meant loans weren't lucrative, and Wall Street could earn fees selling loans to the market. Now, though, interest rates are higher, and banks are losing both lending and fee business to pools of private money, where new borrowers like data center builders have been going. So investors might want to focus on banks that see a productive future use for the capital they don't strictly need today. JP Morgan Chief Executive Jamie Dimon said last year, excess capital is not wasted capital, it's earnings in store. At its recent investor day, JP Morgan suggested an alternative framework. If a use of capital returns more than it costs to raise it, it can add value for shareholders, even if it is lower than the bank's overall return on tangible common equity. So buybacks shouldn't go away. Banks continually generate capital through their earnings. Unless they return some, including via dividends, it can pile up faster than when an ambitious banker can deploy it. But banks are laser focused on shrinking, may not be ready to take on new competitors, or to take advantage of what a more liberal regulatory regime might also allow them to do, like major acquisitions. Remember, money can't actually burn a hole in your pocket. So, in other words, what he's saying is that there's a lot to digest there. Basically, banks could go on a stock buyback spree, but should they go on that stock buyback spree? In other words, what is it doing for you? How are you putting that money to work, and what can it make you? Interest rates are a lot higher right now, meaning that you could, in other words, you lend some money. You lend money to a business at 6.75%, 7%, 7.25%. Those aren't bad rates of interest to be getting on loans if you can get them. Unfortunately, loan demand is tepid at the moment. but for the loans that you can get them, that's great. You can also, you also have a lot of debt that's rolling over, and you can reprice those loans at much higher interest rates, thus again benefiting the bank, making the bank more money. That's a good thing. So again, there's a lot to consider there, but I think the point of what he's trying to say is that a lot of people, again, Senator Elizabeth Warren, automatically assume that banks are just going to run right out and they're just going to take this money and they're going to run right out and buy all this stock back and make the executives rich. And that's what they're going to do or whatever. And that's not necessarily the case. Like, yes, some banks will do some stock buybacks, maybe. And what that little blurb I just read there is saying is that maybe they should, if it makes sense for them to do so. Again, you have to depends on the position for that bank, where they're at, what they're trying to do. Are they trying to make acquisitions? Are they not trying to grow at the moment? Are they trying to just lend money out and grow organically? It all depends on the strategy and the position for that particular bank. But I think what he's trying to say there is that basically, is every bank going to immediately run right out and start doing all these stock buybacks? No, they're not. So again, I thought that was a nice little piece there by Telus Demos, and it was a good, very, very instructive. Maybe a little complicated if you're not used to reading about stuff like that, but again, not too bad here. So, okay. Couple of interesting articles here. So bond investors stay cool despite heated debate over government borrowing. So tepid inflation, mixed economic data, and signs that the Trump administration will limit longer-term debt sales are fueling optimism. This bond market rally has legs. So despite deficit concerns, U.S. Treasury bonds have rallied, spurred by hopes the Federal Reserve will cut interest rates at some point. The fiscal outlook remains largely unchanged since the election, with deficit forecast for 2026 only slightly increased. Optimism is growing that the Trump administration will minimize long-term Treasury issuance, easing investor anxieties. So not everybody on Wall Street is panicked about the U.S. fiscal outlook. Just a month ago, a sharp sell-off in U.S. Treasury spurred widespread alarm that the bond market might finally be buckling under the pressure of outsized U.S. borrowings, but bonds have rallied since, boosted in part by mild inflation data that have driven up bets that the Federal Reserve will cut interest rates by the fall. Now, with Republicans trying to push their giant package of tax cuts and spending measures over the finish line, here's a look at how the nuances of the U.S. fiscal situation are driving swings in the bond yields. So again, I don't want to digress into this whole thing, but it talks about basically deficit in yields. Then it goes on to say, basically a steady forecast. Again, this is kind of an interesting chart here. Evolution of fiscal 2026, the deficit forecast. So July 24, we're running about 1 point. And now this is the deficit. If I go back to and I apologize. You know what? I just realized. I apologize. I usually start off every episode by showing the debt clock and showing where we're at. I didn't do that tonight. I apologize, everybody. Oh, gosh. Okay. So again, last week, we went over the 37 trillion in debt mark, as you can see here in the top left-hand corner. Our U.S. federal deficit, our annual deficit, still rolling at a little over $2 trillion. The Doge clock is now up to $534 billion, with savings per taxpayer of $4,761. Our debt to GDP remains at 123%. But the budget deficit hasn't. I mean, it's kind of interesting that the national deficit is going up. The national debt's going up. But our federal budget deficit hasn't really budged all that much. I mean, it's basically stayed in this bandwidth of this $2 trillion here for, pretty much the last 6 months now. Hasn't really moved much. All right, let me see here. Where was I at here? Okay, but now going back here. So in July of 24, a year ago, we were basically running at, 1.85 trillion deficit, and they got a little bit higher. And then by January of this year, we were up to almost 2 trillion. And now April of 2025, we're basically at 2 trillion, which makes sense because, again, going back to the debt clock, that's where we're at here. But again, the projections beyond this are that basically this number hopefully will start coming down a little bit, not a huge amount, but maybe getting back down to about 1.75, something like that, something in that neighborhood. So again, not a huge dent, but it's not expanding. Let's put it that way. Like this is I think one of the worries here is that this was going to expand up to probably about 2.25 to $2.5 trillion, which we still may get there, depending on how things shake out. But we'll see. And then it talks about like anatomy of a sell-off here. But I want to keep going because I want to look at two other articles here. I got this article here, which I thought was very informative about, China. China is the largest holder of our national debt outside of the Fed. So you've got, the Fed holds a huge chunk of our national debt. Then you have China and Japan, the other two largest holders of our national debt. So there's always this kind of thought in the background that, hey, if Beijing really wanted to cripple us, they could just sell all that national debt that they're holding, right? Well, we'll come back to that in a second. And then the third article here was how big banks can profit from the bond market angst. So, and again, I just thought that this article was about a month old now, but I thought it was very informative just to kind of like big picture thinking here. So, all right, but let's go back to this article on Beijing here for just a second. So will Beijing de-dollarize or dump U.S. Treasury debt? Tough trade talks could lead Beijing to threaten de-dollarization or sell U.S. Treasury debt to gain concessions from Washington. Or could it? So, anticipating what tactics Beijing may use against U.S. President Donald Trump amid trade negotiations, several media outlets here in Europe and elsewhere have begun to speculate that China will threaten to distance its economy and its trade from the dollar, de-dollarization in the popular parlance, and perhaps sell off its extensive holdings of U.S. Treasury debt. Neither act, however, is at all likely, certainly not as an immediate bargaining chip. It is easy to see why commentators would seize on notions like de-dollarization. Beijing for years has sought to raise the yuan's international profile, often at the expense of the U.S. dollar. In its wide-ranging Belt and Road Initiative, for instance, the Chinese regime often insists that arrangements and contracts are denominated in yuan and not dollars, as is customary elsewhere. Beijing, moreover, has promoted the idea of moving away from the dollar among the so-called BRICS nations: Brazil, Russia, India, China, and South Africa. China's Asian Infrastructure Investment Bank denominates loans and grants in yuan, not dollars. Beijing has contracted for large oil purchases in yuan, not dollars. Its extensive dealings with Russia dispense with the use of the dollars, and the People's Bank of China has aided the effort by promoting a digital yuan. But here's the but. Beijing is also well aware that China, as an export-dependent economy, must hold dollars to back its trading activities with most nations. For all Beijing's efforts to supplant the dollar with the yuan, the dollar nonetheless acts as a basis for 80% of the world's import-export activity, even when Americans are not involved. The dollar has a presence in 90% of all currency transactions, compared with only 4% for the yuan. So, did you get all that? Let me say that again. Let me read that again. For all of Beijing's efforts, and they have a lot of efforts. We just went through a whole paragraph of things that they're doing, right? For all of their efforts to try to supplant the dollar with the yuan, the dollar nonetheless acts as a basis for 80% of the world's import-export activity. Even when Americans are not involved, the dollar is still there. The dollar has a presence in 90% of all currency transactions, compared with only 4% for the yuan. So China could shed the dollar and still have access to global trading and currency arrangements, but it would have to accept much less effective and efficient arrangements to do so. In other words, de-dollarization would hurt China much more than it would hurt the United States, and both Beijing and Washington know this. Nor is China likely to threaten the sale of its holding of U.S. Treasury debt. There is no denying that China's holdings are huge. Some estimates put the figure at just under 1 trillion, second only to Japan's holdings of about 1.13 trillion. This would seem to give Beijing leverage, but all involved know that the sale of these holdings would deny China a liquid market in which to invest its necessary holdings of US dollars. Moreover, an extensive sale would depress the price of US Treasury bonds, imposing losses on Beijing's balance sheet at a time when China's domestic economic troubles would make such a loss especially hard to bear. To be sure, such a sell-off would hurt Washington, but it would hurt Beijing even more, and both sides know it. Beijing also knows that China's interests would suffer from the tendency for any of these steps to weaken the dollar's foreign exchange value and strengthen the yuan. In these circumstances, China's central authorities would do better to weaken the yuan's foreign exchange value, especially against the dollar. Such an action would make Chinese goods cheaper to dollar-based buyers and accordingly offset some of the adverse pricing impact of existing and threatened U.S. tariffs. Instead, the yuan has recently gained value against the dollar. Beijing could reverse this trend if it were to talk down the currency actively by publicly eschewing de-dollarization in any talk of selling off holdings of U.S. Treasury debt. So, again, this is a great little article and a great piece basically telling us and explaining why Beijing, that threat of dumping dollars, could they do it? Of course, they absolutely could do it. Will they do it in a real sense or a practical sense? No, absolutely not, because it would kill at a moment when their economy is battling some major problems. They just had a major credit bubble burst, perhaps the largest real estate bubble burst in the history of the world, and they're doing a great job of hiding a lot of the numbers right now, as they always do. But China is really hurting economically at the moment, really hurting. I've reported on it. Yeah, if anybody's been watching, the live stream for the last few months, I've really reported on this and shown how, China's they're having a lot of problems over there right now. So again, I think this piece here was very informative on basically the fact that yes, there is a threat that China could dump our treasury, but probably not likely. We're really not a likely scenario because of how much it would hurt China. It would still, like I said, it would hurt us. It would crush them, and they know this. Okay, so how can big banks profit from this angst in the bond market, if you will? Well, lenders face plenty of risks, but rising longer-term interest rates can actually work to their advantage. So the recent leap in longer-term U.S. Treasury yields has unnerved investors, but it could play into the hands of the country's lenders. One upshot of this is what's known as a steeper yield curve. This means shorter duration securities, such as those that mature in a matter of months, are yielding less than longer duration ones. The difference in what 2-year and 10-year Treasury yield recently has been around its biggest since 2022. If that continues, it's a big change and good news for banks. For years, the curve has been fairly flat. That meant yields were roughly the same at different maturities or even inverted. So if we look at the chart here, if you see, so zero, we have the line across the middle here in zero. So when the blue line goes below zero, that means the yield curve is inverted. And basically we had one of the longest and I've talked about this in many episodes. We had one of the longest and deepest yield curve inversions on record. In fact, the only one that was worse was the one that hit us right before the Great Depression hit, or the stock market crash rather of 1929. Yeah, not a great comparison there, right? But we've since gone back to positive territory, and it's bouncing back, which means what they call a steepening. We're now experiencing a steepening of the yield curve, which can actually be really good for banks. So that meant yields were roughly the same at different maturities or even inverted, with shorter term yields higher than longer term ones. Those were challenging curve shapes for the core business of banking. Banks get the bulk of their funding in the short term market in the form of deposits. Payouts on those are mostly linked to very short term rates. Then they either lend out or invest these funds, typically in longer term assets such as loans, mortgage bonds, or long dated treasuries. The difference between the rates at which they borrow and lend their profits, also referred to as their net interest margin. The steeper the curve, the better it is for lending profits. So even if the short term picture for the US economy is muddied by tariffs, concern over long-term deficit expansion and inflation could actually fuel an improved dynamic for banks' core lending profits. Improving net interest margins, which have been below their long-term levels, could help buffer some of the other headwinds banks face. These include fears that a trade war could tip the U.S. economy into recession. So, again, the point here being is that, this is not always a bad thing for banks from a banking perspective. You want a steepening yield curve. That's how you increased your net interest margin. That's how you make more money. That's a good thing. It also is going to play in very much how you manage your balance sheet in these times. How do you position yourself? And then we get into, like we said, we've had conversations in the past about asset and liability committee, ALCO. How banks are managing their assets and liabilities, how they're looking at interest rate shocks, how they absorb those shocks. So, okay. All right. All right, let's see here. Where am I at here? Okay, I am right on time here. I'm hitting the hour mark. So, okay, what I want to do is here a non-paid plug for Diet Coke at the moment. If anybody knows anybody at Diet Coke and they want to get me a sponsorship, that would be fantastic. Anyway, I digress. Okay, so all right, let's jump out of that for a minute. Okay, so what I want to do now is what I like to do at this point in the show every week is I want to talk about what were the 5 episodes that I put out this week. I want to give you guys the economic indicators for the week, and I want to talk about some banking news. So let's jump into, I'll tell you what, we'll go through the episodes that I put out this week. I think people will find some of them very interesting. Okay, so on Monday, I continued the crypto series with part 22, and this was basically titled Crypto Legislation, Crypto Kidnappings, and More. So part 22 of the crypto series. In this episode, we review all the latest news in the crypto world. The Genius Act passes the U.S. Senate. Shares of Coinbase and Circle ride high. Stablecoin legislation could juice demand for treasuries. Very interesting. Walmart and Amazon may create their own stablecoins. Various companies are investing in crypto. The DOJ seizes a record $225 million in pig butchering scams. JP Morgan to launch a deposit token. The former founder and CEO of Celsius, which was a crypto firm, gentleman named Mashinsky, he ended up getting 12 years in prison for basically being convicted of fraud. And then cryptocurrency holders are becoming the targets of abductions, beatings, and kidnappings. So gets rather wild there at the end with some of the people in the crypto world who are going to jail, and then some of the crazier things that are happening with these crypto kidnappings, which are very fascinating. So I thought it was a great episode. I think people will, if you're following the crypto series, which I hope you are. I think there's a lot of great information in that. Okay. And then on Tuesday, I actually tried something new. I actually did an AI update. Now, while this does not maybe have a direct correlation between like the banking and finance world, I'm following it because I think what is happening in the AI world obviously is heavily influencing so much of what's going on. And there are so many fintechs that banks work with that want to incorporate AI into what they're doing and thus incorporating AI into the bank. I just think it's very important to follow what's going on in this space. So this episode examined a series of AI-related articles from the Wall Street Journal and the Epoch Times. The articles primarily covered AI-related developments with Meta and OpenAI. Meta is seeking to fully automate ad creation using AI and is teaming up with a company called Anduril If you don't know who Anduril is, I suggest you look them up. They're a fascinating company there. The gentleman who started and founded and is the CEO of Anduril actually used to work for Meta, and then he got fired, and then he went and started this company, and now he's just wildly successful at the moment. So very interesting there. But Meta is going to partner up with Anduril to develop combat VR headsets for the Army. OpenAI has committed to developing a gigantic data center in the UAE. Former Apple designer Jony Ive has been brought in to develop new products. They announced the release of an AI companion device next year. The company has abandoned plans for a for-profit conversion, and their relationship with Microsoft is deteriorating quickly. One article is examined that pushes back on the current narrative that AI is on the verge of superintelligence. And then finally, there is an article on Anthropic's AI model and how it threatened engineers with blackmail to avoid shutdown. That is a wild story, how the AI threatened engineers with blackmail. It's a wild story. I would point out one other thing here. So OpenAI, Joan Ivey, legendary developer of products over at Apple. So Joan Ivey, he left, started his own company. And now OpenAI wants to buy, I think, his company for about 6.5 billion, something in that neighborhood. And they want to bring him in and they want to make him like the primary designer of products for OpenAI. However, a massive lawsuit was dropped against Joan Ivey and his company. I think it's called IO. This week, Elon Musk had no problem flaunting that online. Very interesting. But so obviously, much more developments, a lot more happening in this space. So obviously, I think one of the key things to look at is that relationship between Microsoft and OpenAI. I mean, that thing is just that relationship is going south real quick there. And given the fact that Microsoft has invested $14-15 billion in OpenAI, I don't think OpenAI is just going to be able to walk away from that like willy-nilly or maybe as easy as they think they are. So, okay, so that was Tuesday. Then Wednesday, I put out episode 412, which was what is the impact of stopping penny production? So I thought this topic was actually a lot more interesting than I thought it was going to be at first. The Treasury has announced that basically they're going to stop production of the penny early next year. So I found this blog post from PCBB that was titled "The Impact of Halting Penny Production." So as a result of high production costs, the U.S. Mint will discontinue printing pennies in 2026. What does this mean for banks, businesses, and consumers? Banks may see adjustments serving cash-based businesses and coin inventory changes. Businesses may need to change their marketing strategies and how they price certain items. Like, in other words, can you price something at 99 cents anymore? Or does it have to be 95 cents or $1 or 105, some, again, subtle, but very interesting things, right? Consumers could see a disproportionate impact on the unbanked and low-income families because of this. Surprisingly, again, that's why I said this was a little bit more interesting. You kind of sit here and you go, oh, well, it's just a penny. I mean, who cares about pennies? Whatever. I don't use pennies, or I just, my pennies sit in a jar for years until I take them over to the bank and cash them in. So again, may seem like a rather mundane thing, but there could be some very interesting dynamics here. Now, I will say, to be fair, I think Europe got rid of pennies a few years ago, and basically, I don't think it's really bothered anything. I think it's really been fine for the most part. So yeah, again, something I thought it was an interesting topic, something interesting to cover. On Thursday, I did episode 413, which is what is your bank's data strategy? So this episode examined an article from Bank Director that was titled "Crafting Your Data Strategy." The article considers how advancements in technology can enable community banks to unlock greater labor efficiency, new revenue opportunities, and create better risk management. And this all depends on the bank's data strategy. The article considers potential blind spots in your existing data strategy, advances in technology, and the need to get started now. So the question at the end becomes, what is your bank's data strategy? Which I think is absolutely critical. You have to have a really good data strategy in order to if you really want to understand your customers, understand, their wants, how good your service really is at the end of the day. Like, are you really delivering that customer experience that you think you are? I think a lot of that depends on your data and how you're looking at it and what you're doing with it. So, okay. And then finally, earlier today at 12 o'clock today, I had episode 414 came out, which was called Checking Up on Millionaires in the U.S. Now, this episode examined 3 articles from Investopedia, and the articles were titled, How Many People Retire with 1 million or more in their retirement account? The number might surprise you. It certainly surprised me. Which generation is the wealthiest in U.S. history and why? The boomers. And the U.S. added over 1,000 millionaires a day last year, more than anywhere else. And that was from UBS, part of their 2025 Global Wealth Report that they put out. These 3 articles together could give us a very interesting look into what is happening with the millionaire class in the U.S. The boomers continue to be the wealthiest group of millionaires. A lot of millionaires are created each year on paper. That's a very important distinction, on paper. And yet very few people retire with 1 million plus in their retirement accounts. It's literally like, I couldn't believe it. Like 2% of people out there actually retire with $1 million plus in their retirement accounts every year. It was I was pretty blown away by this article and the data that they had in there, describing, how many millionaires actually get there. Like, in other words, a lot of millionaires in the United States are millionaires on paper because they have a lot of equity in their house. Like, they might own a house that has $500,000 of equity or $400,000 in equity. But most millionaires out there are not truly liquid millionaires, meaning it's like, you don't have any debt and you got $1 million plus sitting in a retirement account, so you're liquid, baby. You are a liquid millionaire. There are very few people are in that position. Which I thought, again, was very interesting to me. I thought there would be a much higher percentage. Now, keep a couple things in mind. So it says on here that, the U.S. added over 1,000 millionaires a day. I think, I don't know about all that. I would really like to see a lot more of the data on that. But again, the U.S., I believe, does have a higher proportion of millionaires than any other country in the world. I know I've read that in a couple of places. I'm pretty sure that's still true. If anybody wants to fact check me on that one, I have no problem with that. Fact check me on that and let me know if that is in fact the case, or not the case. But those are the 5 episodes that I had coming out for this week. Now, what do I have coming out in the next 2 weeks? So next week, I have some really good stuff coming out next week. We have another installment of the crypto series coming out because I had a whole bunch of new stuff to cover there. We had some reports from the OCC, released some first quarter 2025 reports on mortgage metrics and derivative activities and bank trading activities. So I got reviews on those coming out. Bank Director put out their 2025 compensation and talent survey, a very interesting survey that they put out every year. So I covered that. And then on Thursday, big announcement. I continued the Lords of Easy Money series with an interview with former Fed Governor Dr. Thomas Honig, who was the principal character of that book. This was huge interview. Do not want to miss this interview. If there's one interview that I put out this year that you want to watch, this is the interview you want to watch. And that's going to come out on Thursday. And I'll talk a little bit more about that as we get to the end. And then on Friday next week, I'm actually doing what I'm calling a 4th of July special. I wanted to do something that I felt was patriotic for the 4th of July. I had been waiting to cover the ultimate economic classic, The Wealth of Nations by Adam Smith. The Wealth of Nations, published in 1776, was the basis for capitalism, the economic theory that is capitalism, and what some people describe as the economic Bible. But I do a whole coverage on not just the book itself, but I give some background on Adam Smith. I give a lot of context in terms of the moment in which it was published, just the kind of revolutionary and independent fervor, if you will, that was going around not only the U.S., but around the world at that particular moment. The way that people were looking at economics and considering these different economic theories, and how, it just, how in the world does all this come together in that one moment in 1776? How does all this come together where, we're fighting for independence? Adam Smith just happens to write one of the greatest economic treaties of all time, creating the concept of capitalism, and which becomes the perfect economic model for what the U.S. was trying to achieve, in terms of as a new country, to enable people to have free markets and have growth and prosperity with limited government. It's just there has to be some level of divine providence in that, right? There just has to be. And so anyway, so I do that. That's all in the 4th of July special, which will come out on Friday, the 4th of July. So I hope that everybody enjoys that. The following week after that, I'm actually going to be calling it. It's actually going to be called Book Week, and I picked 5 individuals in the finance and economics world that I deemed true characters. Okay, true characters, and I think you will agree with this when you hear the list here that I'm putting out. So basically, here's the list of 5 individuals that I'm going to be going over next week. So we're going to start off with John Law, who, this book, Millionaire, was all about a biography of the character named John Law. John Law became famous in the 1700s for basically creating the first, basically he's considered kind of like the father of modern economics, if you will. And he created a massive boom and bust in France back in the 1700s. It was spectacular. I've got The Greatest Trade Ever, which was basically all about John Paulson and Paulson and Company, and the bet that he made against the housing market during the 07-08 financial crisis, and how he was able to take home over $4 billion in that. We are covering the classic. I'm sure some of you may or may not like this. I'm covering it anyway. We're covering the classic, The Art of the Deal, from Donald Trump. I promise that there were characters here, right? There are definitely characters. We're going to go over Reminiscence of a Stock Operator. This is basically a this is a fictionalized biography of Jesse Livermore, who was one of the greatest Wall Street traders that ever lived. He made fortunes and lost massive fortunes. An amazing character. And then finally, I saved the granddaddy of them all for the end, John Jacob Astor. Now, a lot of people out there today are going, who is John Jacob Astor? They don't know. John Jacob Astor was, if I could use today's parlance, he was the pimp of all pimps, the granddaddy of all granddaddies. John Jacob Astor created the mold of what we know as the American-made entrepreneur, living the American dream. John Jacob Astor set the mold. So many things that you think about today, when you think about like the richest man in America, Elon Musk, John Jacob Astor was the first guy to be considered the richest man in America. Real estate mogul, business inventor, business entrepreneur, philanthropist. Okay, the whole notion of philanthropy, okay, created by John Jacob Astor. Now, there has always been networking in one way, shape, or form since the beginning of time. I mean, you could talk about networking in very different aspects, but John Jacob Astor kind of, in a very real way, kind of modernized the thought of networking. He used his hotels to garner networking amongst the social elite in New York City. I mean, again, you could talk about John Jacob Astor for days. But again, it's funny. Where do you think Trump got all his grandioso ambitions? Where do you think he got this whole idea of this kind of larger than life personality and the luxury and the grandiose personality and all? Where do you think that all came from? Came from this dude. Came from John Jacob Astor. He's the guy. John Jacob Astor created, have you ever heard of a hotel called the Waldorf Astoria? Yeah, that was John Jacob Astor. John Jacob Astor also created the Astoria House. Another famous, these were hotels all over parts of America. But they were known for the splendor, the luxury, the grandiose of the buildings. John Jacob Astor, he set the template for everything and everyone that came thereafter. Basically considered the first millionaire, again, as the richest man in the United States. At one point, he owned, I think it was like almost like 20% of all the wealth in the United States was owned by, had been accumulated by John Jacob Astor. I mean, just an amazing sum of money at that point in time in history. But so those are the basically 5 biographies that we're going to be doing in 2 weeks. I hope people will find a lot of those interesting at the time. We'll see. We'll go into that later. But again, that's what I've got planned coming out here for the next 2 weeks. So, okay, let us then, I want to get into, let's talk about, okay, what are economic indicators coming out for this week? So on Monday, June 30th, we get the Chicago PMI. We get the FOMC member Bostic is going to speak at 10 a.m. On Tuesday, July 1st, we get the Fed Chair Jeremy Powell is going to speak at 9:30. We get the manufacturing PMI, the ISM manufacturing PMI, the JOLTS job openings, and we get the API weekly crude oil stock. On Wednesday, July 2nd, we get the ADP non-farm employment change. On Thursday, July 3rd, we get continuing jobless claims, initial jobless claims, average hourly earnings. We get the non-farm payrolls, the participation rate, trade balance, unemployment rate, services PMI, and the ISM non-manufacturing PMI. So those are your economic indicators coming out next week. Obviously, the market closed on July 4th, so there won't be any economic indicators coming out that day. But that is the stuff we have next week. So obviously a lot of economic data coming out on Thursday. So that will be a big day. So, okay, let's get into some of the bank news. So I want to hit let's look at some economic indicators here, shall we? So the FFIEC basically publishes HMDA data. So the Federal Finance Institutions Examination Council published data on 2024 mortgage lending transactions reported under the Home Mortgage Disclosure Act. The FHFA, enterprises mortgages performed well in the first quarter. So the Federal Housing Finance Agency reported that 60-day delinquency rate for Fannie Mae and Freddie Mac decreased from 0.83 at the end of the fourth quarter of 2024 to 0.77% at the end of the first quarter of 2025. So the enterprise's 90-day delinquency rate remained at 0.57% at the end of the first quarter. So that means everything's pretty much good, right? Fed releases agenda for July conference on large bank capital requirements. So the Federal Reserve published an agenda for its July 22nd integrated review of the capital framework for large banks conference. The conference will be live streamed for the public. It will feature discussions on the Basel III Endgame rules, the stress testing framework, the capital surcharge for the largest banks, and leverage requirements. Let's keep rolling here. New home sales decreased in May. We'll look at that in a little bit. Mortgage applications increased. We'll also look at that in a few minutes here. We'll get back to some of the articles. Consumer confidence down in June. We'll talk about that. Home prices slow in April. We'll talk about that. Let's see here. Rural Economic Index reaches 2-year high. So Creighton University's Index of Rural Economic Conditions rose to its highest level since July of 2023. OCC mortgage performance up year over year. So according to the latest OCC mortgage metrics report, 97.6% of mortgages included in the report were current and performing at the end of the first quarter. So that is good news. Fed to Congress will carefully assess data before more rate cuts. Yeah, we heard all about that from Jeremy Powell. Okay, so GDP decreases 0.5% in the first quarter. So gross domestic product decreased at an annual rate of 0.5% in the first quarter. Durable goods orders increased in May. So new orders for manufactured durable goods increased 16.4% in May after decreasing 6.3% in April. Pending home sales increased in May. Mortgage rates dropped slightly. We'll talk about that. So, okay. Advocacy Week in Review. So this is from the ICBA. So this basically says that the House Financial Services Committee Chair French Hill, to ensure any legislation establishing a regulatory framework for currently unregulated stablecoins considered by the House includes guardrails against negative economic consequences that would result from community bank disintermediation. They told the Consumer Financial Protection Bureau that community banks already meet the requirements of Section 1031 of the Dodd-Frank Act by providing consumers with electronic access to their financial data through online banking portals and mobile apps. And the statute only mandates data access directly to consumers, not to third parties. So again, I have railed against open banking all year. I hate it. I don't want it. So now ICBA is basically making the argument to the CFPB that basically, hey, we already meet the requirements of the Open Banking Act. We don't need to do all this extra stuff that the act proposes. So, and then finally, they called on the Senate Finance Committee to make permanent and expand Section 199A deduction from 20% to 23%, which would support subchapter S community banks and other pass-through businesses. ICBA, they also shares community bank digitalization priorities with the OCC. So ICBA said the OCC should adopt a modernized and responsive regulatory framework that enables responsive innovation while preserving the safety and soundness of the financial institutions. FATF, a stronger action needed to stem digital asset risks. So the Financial Action Task Force said stronger action is needed to safeguard the integrity of the international financial system from the risks posed by virtual assets. So, very interesting. More to come on that for sure. Let's that over here. So, regulators propose changes to mega bank leverage ratio. We already talked about that a little bit. So let's look at, keep going here. Scott, the Fed must right-size regulations. So Senate Banking Committee Chairman Tim Scott said the Federal Reserve must right-size the regulatory framework to eliminate unnecessary burdens, especially for community banks. Let's see here. Hill pledges to work with Fed's Bowman to support community banks. So House Financial Services Committee Chairman French Hill congratulated Michelle Bickey Bowman on being named Federal Reserve Vice Chair for Supervision and said he looked forward to working with her on banking issues. Nissan became the latest automaker to apply for the ILC charter. So Nissan this week became the latest automaker to apply to form an industrial loan company in Utah. So Nissan Motor Acceptance Company, the financial services arm of Nissan North America, submitted an application to the FDIC and the Utah Department of Financial Institutions to form an ILC based in Salt Lake City. Nissan said the proposed ILC would focus on commercial financing for dealerships. So again, I just did an episode on the whole ILC loophole and why it should be banned, why it should not be. So if you want more information on that, I highly suggest go check that episode out. Homeland Security warns of heightened cyber attack threat. So the Department of Homeland Security said that because of ongoing conflicts with Iran, low-level cyber attacks against U.S. networks by pro-Iranian hackers are likely. So bank merger law enacted. So President Donald Trump signed into law SJ Resolution 13, which reverses an OCC rule that imposed burdensome standards on bank mergers and would prevent the OCC from issuing any rule that is substantially the same. So that's good news. Fed to cease examinations for reputational risk. We talked about that. Fed's Bowman community bank leverage ratio should be recalibrated. So Federal Reserve Vice Chair for Supervision, Michelle Mickey Bowman, said the Fed should reconsider capital requirements for a wide range of banks, including the calibration of the community bank leverage ratio. So I don't disagree with that, but we'll see what happens. Already talked about that. Already talked about stablecoin policy. This is a big one. This is a huge one. So the House passes ICBA-supported bill to restrict mortgage trigger leads. Yes, the House of Representatives passed the ICB-advocated legislation to restrict credit reporting agencies from selling consumers' contact information when they apply for a residential mortgage. So now I believe this passed the House. So now it's got to go to the Senate. Which hopefully it will pass in the Senate and it'll go to the president for its signature. But for anybody who is unaware of the whole mortgage, the trigger leads. So what was happening with that was so you go to apply for a mortgage, and the minute your credit gets pulled, all of a sudden your phone starts blowing up. You start getting emails, text messages, phone, like 100, and I'm not talking about a couple. I'm talking like 100 phone calls, just like within a couple hours. A lot of people were blaming banks for this. They were basically like, oh, it had to have been the bank. The bank had to have sold my information, or the bank did something. It was not the banks at all. It was the credit reporting agencies that were doing this. So the credit reporting, so basically the bank goes, you start the underwriting application, the bank goes in, one of the first things they do is they pull your credit as part of the underwriting. And when they pulled the credit, who am I thinking of? TransUnion, Equifax, Experian. They would then sell, this lead, thus the trigger lead. So the pulling of the credit is the trigger, and then you are the lead. So thus the trigger leads. They would then sell that to other mortgage companies, who would then call you up and say, hey, before you make a final decision, you should give us a shot. Obviously thousands of consumers out there super annoyed and aggravated at that whole thing, understandably so. But hopefully that passes and that gets thrown out, and none of us have to worry about the whole trigger lead thing anymore. So FATF, so North Korea, crypto crime are major threats. So the criminal use of cryptocurrency is a major concern, and North Korea is the biggest threat, the Financial Action Task Force said. So very interesting. So North Korea continues to be a pain in the butt, if you will. Okay, so that's the banking news, economic indicators. We went over episodes for the week. So now let's get back to some articles here, shall we? We still got another half hour left, and I still got a ton of stuff to go over with you guys here. So this is interesting. Family offices double down on private credit and infrastructure during private equity slump, survey finds. So private investment firms of wealthy families are investing more in alternatives, i.e. private credit, according to a new BlackRock survey. As investor frustrations with private equity mount, private credit and infrastructure are gaining market share with family offices. BlackRock's Armando Senra told CNBC which niches these elite investors are flocking to and why. So I know private credit is hot at the moment, but private credit has also been a major issue for me, because I think that, I think there is a bubble forming in the private credit market. And I think, if it blows up, it is not going to be good. And it could sink a lot of these hedge funds and private equity funds that are out there doing all this private equity business. Furthermore, it is highly disturbing. I saw something. So BlackRock, here's another story here. So BlackRock plans to include private credit and private equity investments into 401k retirement plans. 401k plans. The Wall Street Journal reported, citing Jamie Magiera, if I'm saying the name right, co-head of BlackRock's U.S. wealth advisory business. So the world's largest asset manager plans to offer a 401k target date fund with a 5 to 20% allocation to private investments, depending on an investor's age in the first half of 2026. Now, that is very interesting. It is to me, that is highly disturbing because like, why are you doing that, right? Like, are you doing that because you're hoping that if it blows up, that, that could harm people's 401k plans, thus giving you more leverage over the Fed to basically be able to go back to the Fed and say, hey guys, bailout time. You need to come bail us out, because if you don't bail us out, look at all these poor people that are going to get crushed in their 401ks because, it won't be BlackRock that did this. It'll be them. It'll be the investors. It'll be the 401k holders. It'll be them that did. Oh, these foolish people, went out there and just, we were just giving them what they asked for, and they were foolish enough to go in there and actually, get into these investments because we told them to, but that's their fault. But you need to now come in and bail them out. That's so again, that might be a stretch, might be a little cynical on my part, might be a lot cynical. I don't know. But I just, again, I'm highly skeptical of the whole private credit market. And I think these are, some disturbing trends. Again, what have we learned when we look at market panics, when we look at manias, when we look at, just fads, when we look at all these things that go on here? The mania phase is always the last phase, when everybody wants to get in. Everybody's trying to, Wall Street's trying to find 100 different ways to carve it up and get anybody that wants to be involved in it. And that's like what you're seeing with private credit right now. And I find it highly disturbing. So it's something, again, we'll have to keep an eye on. Another huge development this week. So federal regulators open doors to consider crypto in mortgage applications. So the Federal Housing Finance Administration Director, Bill Pulte, said in a post that he has instructed Fannie Mae and Freddie Mac to consider cryptocurrencies as part of a mortgage application. By allowing cryptocurrencies to count as an asset, borrowers who have crypto holdings could be seen as being in a better financial position to pay the mortgage, potentially increasing their chances of getting the loan. The order instructed Fannie Mae and Freddie Mac to develop proposals that would allow lenders to consider cryptocurrencies, but it offered few other specific details. So again, this is a very interesting development. Once again, trying to offer more legitimate, make cryptocurrencies more legitimate. And this, of course, coincides with the passing of the Genius Act. Not passed in the House, not a done deal by any stretch of the imagination yet, but we'll see. But again, it's a lot of little steps right now that could add up to just a monumental. Things could be very different by this time next year. When you think about it, if the Genius Act passes, if all of a sudden a number of banks jump into cryptocurrency and perhaps start offering it, even in a, what's the word I'm looking for there? Even in a kind of like a holding capacity, even if banks don't want to sell you cryptocurrency or make it available, maybe banks just say, hey, we'll give you a digital wallet and you can use our digital wallet to hold your cryptocurrency and then maybe use it for other things. It's like, there's a lot that could happen here throughout the rest of the year, depending on how legislation pans out, how things like this pan out with, again, federal regulators doing things to try to more legitimize cryptocurrency. So again, it's just another fascinating development, and we'll see. We'll continue to keep an eye on it and see what happens here. So, okay, now let's look at a couple of economic indicator things real quick here. So, blue collar wages under Trump post the largest increase in almost 60 years. So wage numbers are even bigger than the improvements seen at the start of Trump's first term, a Treasury Department official said. So in the first 5 months of President Donald Trump's second term, blue-collar hourly workers have experienced a nearly 2% increase in real wage growth, the most significant growth in the first 5 months under any administration since President Richard Nixon. Hopefully that's what people voted for. This is the good stuff here. New Treasury Department data suggests real inflationary adjusted hourly wage growth is up 1.7% year to date for production and non-supervisory workers. By comparison, real wages declined by 1.7% during the first 5 months under the previous administration. The last time that wages outpaced inflation at this pace was during the president's first term, according to Joe Lavorgna, counselor to Treasury Secretary Scott Bessent. So again, this is a fantastic thing. We want to see this continue. We want to see this go on. I mean, everybody wants to see inflation comes down and real wages increasing. That is a lovely combination to obviously, hopefully, stay away from any potential recession down the road, and also to continue boosting the economy, obviously. Okay. Now here's a couple interesting things I want to show you guys here. And again, this is why I have not put a lot of stock into these consumer sentiment polls, because I'm going to show you these next two articles here. You're going to see one consumer sentiment is like, oh, it's fantastic. The other one, it's like, oh, things are terrible. So, and the real question is there, what's your real takeaway? What do we really take away from that? Consumers shrug off geopolitical conflict to send sentiment higher. So the Michigan Consumer Sentiment Index improved to 60.7 in June, ticking higher than its preliminary reading. Consumers reported improved sentiment for the first time in 6 months. Now remember this, the consumers reported improved sentiment for the first time in 6 months. Consumer expectations improved by more than 20% amid higher optimism over personal finances and business conditions, while inflation expectations also improved. The reading is still lower than the post-election bump in December as worries over the impacts of tariffs persist. Okay, fair enough, right? Now let's look at this article. Consumer confidence falls again in June. And what does this one say? The Conference Board's Consumer Confidence Index fell for the 6th time in 7 months in June, erasing some of May's improvements as uncertainty over tariffs and job prospects weighed on Americans. Nearly 70% said a recession was likely, and consumer fears over future business and employment conditions eroded again, even as their assessment of the current job prospects remained positive. Inflation expectations improved after recent data showed that price increases are slowing, even as economists watch for tariff impacts. So, I mean, wow. I mean, you talk about night and day. So the Conference Board's Consumer Confidence Index fell for the 6th time in 7 months in June, erasing some of May's improvements as uncertainty again over tariffs and job prospects weighed on Americans. Nearly 70% said a recession was likely. I would really love to know who they were polling, because this sounds just wildly out there. I mean, I don't think that 70% of anybody thinks that a recession is highly likely in the next 6 months. I don't think that you're seeing that. But yet we go back to the Michigan Consumer Sentiment Index, improved to 70.6 in June, ticking higher than its preliminary reading, and consumers reported improved sentiment for the first time in 6 months. And then consumer expectations improved by more than 20% higher. Optimism over personal finances and business conditions. That, to me, strikes as a little bit closer to probably where we're at. So, but again, this is why all these consumer sentiment indexes and surveys out there, again, they're all over the place. And it makes it very difficult for any rational person to look at this stuff and basically try to get a real reading on things. You're doing more like, which way's the wind blowing out there? Sometimes I think the best thing is just to talk to people around you. Wait for it. Talk to people around you. Talk to your friends. Talk to your family. Talk to your neighbors. Talk to your coworkers. See how they feel. Now, again, it's a very generic sample size, but that will probably give you a better idea as to what's happening than a lot of these consumer surveys that seem very either biased or just maybe not a large enough population sample. Like, it just, again, I'm very hesitant on these surveys here. So okay, let's run through a couple of housing things here real quick. So sales of new homes tank in May. Pushing supply up to a 3-year high. So sales of new single-family homes dropped 13.7% in May compared with April, according to the U.S. Census. Home builders who reported quarterly earnings recently noted high rates cutting into affordability. This is what Bill Pulte was railing about. Remember, Bill Pulte's the head of the FHFA. Earlier in the evening, I was talking about how he spent his whole week last week railing against Jeremy Powell and saying how Jeremy Powell was killing the housing market with his high rates. This is exactly what he was talking about. So sales of new homes tanked in May, and now the supply of new homes is seeing a 3-year high rather. And let's continue on. May home prices increased very slightly, but prices hit another record high. So now this is on existing homes. Okay, so first we got new homes. Now we're talking about existing home sales. So there were 1.54 million housing units available at the end of May, an increase of over 20% from May of last year. The median price of an existing home sold in May was $422,800, up 1.3% year over year. Homes are taking longer to sell at 27 days versus 24 days a year ago. Now, I would say if you put a house on the market and it's still selling within a month, that's pretty good. That's not bad. Like that's really not a bad thing. I mean, if you put a house on the market, we were seeing ridiculous things for a few years there where you basically didn't even get the house on the market and it was sold. I mean, you put the listing out there and within 5 hours you had 25 offers of over asking price and your thing was gone. Now we're starting to get just a little bit more back to normal, right? We're getting back to taking 24, 27 days to sell a house. 30 days to sell a house is totally normal. That's not like out of any kind of crazy range there. Medium home prices are still going up, but only going up a very minimal amount of only 1.3%. So we are seeing a cooling in the housing prices, and the inventory is increasing, and the inventory is up to over 20%. But again, the inventory is going up because houses are sitting longer. Some houses are just sitting in general and not selling and not moving. And so again, we're just seeing the housing market just stuck in the mud, basically. So let's go. I got 2 more articles for you guys here. So home price hikes are slowing more than expected. So home prices in formerly hot pandemic markets are now starting to fall. Mortgage rates remain stubbornly high with no sign of dropping. Whose fault is that? Prices are unlikely to drop dramatically as there are still too few homes for sale. I think that might depend a little bit more on the neighborhood that you're in or the state or the area you're living in. And then finally, mortgage rate and demand are stuck in a holding pattern. No bleep. No, you know what. Mortgage demand from home buyers barely moved last week. The average rate on the 30-year fixed mortgage rose slightly despite lower treasury rates. Refinance demand was 29% higher than last year, but that is coming off a very low volume. So again, very interesting. But we're if you look at again. It's looking at all this stuff in context. If we look across these 4 articles, we see that, new home sales are really slowing. The volume is leading to a 3-year high of stock. We're seeing existing home sales are beginning to slow down. Again, the volume of houses on the market is building. Home prices are still going up, but going up just a little bit. And we're seeing here that basically mortgages are just, the rates are stuck within I would say mortgages have been stuck in a bandwidth of like 6.85 to 7.15 fixed 30-year fixed rates. I mean, that's where the rates have been stuck for the better part of the last, 6-7 months. And they kind of fluctuate in that bandwidth. So again, this just gives us a pretty solid idea as to where the mortgage market is at. So, okay. So let's shift gears here for a minute now, back to some of the regular news. So, Senate official blocks the CFPB defunding in the Trump's mega bill. So, measures to defund the CFPB and to reduce salaries at the Fed fall outside the limits of reconciliation. Senate parliamentarian Elizabeth McDonough ruled on Thursday. So, all I will say on this is that, okay, she ruled on this. We shall see what happens. I think that there is a very good chance that she will probably get overruled in some of this, because this has become obviously a very, very partisan hot potato, if you will, over there in the Senate as part of the big, beautiful bill. So, we will see. But this does not, even if this is successful and they basically say, nope, you still have to give funding over to the CFPB. It's not. This is not the end of this by any stretch of the imagination on either side or either way, one way or the other. But again, just good to keep an eye on. So that was the first thing. So now 4 days later, we get the Senate shrinks the proposed CFPB cuts in the mega bill. So 1 week after the Senate parliamentarians struck down efforts to zero out the CFPB funding, lawmakers released a scaled back proposal. So Senate Republicans have supplanted efforts to zero out the Consumer Financial Protection Bureau within their mega bill with a proposed funding cut that wouldn't affect the Bureau's statutory functions. So again, now you see the compromise. They're coming in. They're basically saying, okay, look, we're not going to zero it out. Obviously going to reduce. They're still going to cut the spending. So let's see here. So the new plan would cap the CFPB's access to funding at 6.5% of the Federal Reserve operating budget, decreased from its current limit of 12%. So Senate, Banking Committee Chairman Tim Scott said the change would save $2 billion. McDonough approved the changes, according to Reuters. So basically, now, they've come to a satisfactory agreement here. So this is what has transpired and played out over the last week. So again, I think both sides kind of got what they wanted. I think the Republicans really wanted a decrease in the budget at the CFPB. At least that's the first step that they're taking in trying to hollow this regulator out. And the Democrats basically wanted to make sure that something remained, that it didn't go to zero. So again, both sides kind of, panning it out, so to speak there. So, okay. This I thought was very interesting. So the deadline approaches for the Senate to cement DOGE spending cuts. So the Senate faces a rapidly approaching deadline to pass a law codifying $9.4 billion in federal spending cuts by DOGE, the cost-cutting task force formerly headed by Elon Musk. The measure would claw back funding for AIDS prevention and public broadcasting previously budgeted by Congress. The cuts made by DOGE created controversy over whether the president can refuse to spend money budgeted by Congress. The White House may use a different maneuver called a pocket rescission later in the year for the rest of the $180 billion in spending cuts identified by DOGE. But basically the Senate has, I think, 45 days. The spending cuts would be nullified if not passed within 45 days of Trump's letter. So I think that takes them till about maybe the end of July. I think so. They don't have a whole lot of time left to ratify these cuts. And obviously, I think they would have a lot of unhappy constituents if they don't ratify these cuts. So we shall, so stay tuned. We'll see what happens on that one. So, okay, couple of interesting AI-related articles here for the moment. OpenAI, Microsoft Rift hinges on how smart AI can get. So, in other words, not like smart AI, but how, like, in other words, are you going to have super intelligence? So, Silicon Valley is at odds over whether AI can reach and exceed human-like intelligence, a milestone with major implications for the startup and technology giants partnership. So, again, what's happening here is that Microsoft has invested a huge amount of money in OpenAI. Now, if OpenAI can create quote unquote super intelligence, they then don't have to share as much basically with Microsoft. That's kind of the agreement. Microsoft was basically like, okay, we'll get you up and it's going to take you a long time to get there. And in the meantime, we're going to kind of pluck a lot of the low hanging fruit, if you will, of things that you guys come up with and data that you have and all this other good stuff. But basically, OpenAI, on the other hand, is being incredibly stingy right now. And they are basically, Microsoft is not happy. And so now this argument about how quick super intelligence is going to come about is that's really what this is boiling down to in a nutshell. And Microsoft is basically calling this whole idea of super intelligence into question, basically saying, we don't think you guys are going to be able to create super intelligence, like period. Like we don't think it's going to happen. Like you guys, I mean, you maybe in like 10 maybe in 10 or 20 years, but it ain't happening in the next couple of years. So again, just a very interesting argument. I find this whole feud, this whole fight that between OpenAI and Microsoft just getting, I think, more interesting by the day, which is very fascinating. So we'll have to keep an eye on that. Another interesting aspect of this. So Zuckerberg leads AI recruitment blitz armed with a $100 million pay package. Anybody out there want to get $100 million to go work on AI? I thought, I'd love it. I'll take them up on it. So in a bid to address the AI crisis at his company, the Meta CEO has gotten personally involved in recruiting top talent. So Mark Zuckerberg is intensely recruiting AI talent for Meta's new superintelligence lab, even contacting researchers directly. Zuckerberg is offering lucrative financial packages, telling top AI researchers and engineers they won't have to worry about computing power or funding. Some AI researchers are hesitant to join Meta because of past AI project challenges and uncertainty about the company's AI direction. Now, what I had to laugh at in this article here was that Mark Zuckerberg, so he's personally calling these people, and some of the people are literally hanging up on him because they think that it's fake. I mean, who wouldn't? I mean, come on. If Mark Zuckerberg called you right now on the phone and was like, "Hey, listen, I really want you to come talk to me and sit down for, come, let's go have lunch or let's go have an interview. I want to talk to you about bringing you over to come work for AI, and I might pay you like $100 million or whatever." I think people are going to be like, "Yeah, okay, dude, whatever." I am. If anybody has ever seen the one of the great all-time comedies, Major League, from the 80s, one of the famous scenes at the beginning of that movie is Tom Berenger, who's one of the main stars of the movie. He plays the catcher on the Cleveland Indians. They call him up at the beginning of the movie, and they're like, "Hey, listen, we really want you to come and play for the Indians this year." And he laughs and he says, "Come on, man, you at least could have said you were from the Yankees." And he hangs up on him, and the guy's just looking at the phone like, what? And that's almost that's exactly the image I had in my mind. Like somebody's like, "Oh yeah, Mark Zuckerberg. Okay, you could at least said you were Elon Musk," and then click hanging up on him. So again, just interesting stuff though. Let's see here. Okay, this very again interesting. New York to build build one of the first U.S. nuclear power plants in a generation. So Governor Hochul directs the state public electricity utility to add at least 1 gigawatt of new nuclear power production. So New York plans to construct a nuclear power facility, the first major new U.S. plant in over 15 years. Governor Hochul wants the New York Power Authority to add at least 1 gigawatt of nuclear power generation. The project assesses President Trump's executive order to accelerate nuclear power project development. So New York intends to build a large nuclear power facility, the first major new U.S. plant undertaken in more than 15 years, and a big test of President Trump's promise to expedite permitting for such projects. So very interesting. I would not have thought that New York would be the first state to jump on this bandwagon, but here they are. So again, I think this is great. I think this is fantastic. I've been an advocate. Nuclear power is something that I have studied for a long time, and I've looked at all the disasters. I've recommended. There's a whole bunch of. I mean, obviously, there's the Chernobyl miniseries that's out there right now. There are documentaries on 3 Mile Island on Netflix. There's another great documentary you can see about the Japanese power plant that got hit with the tsunami, and there's a whole docudrama on that on Netflix. They're all great to watch. I've watched them all. I would highly recommend everybody watch them all. But what I tell people is that, nobody wants to acknowledge that the nuclear technology has come an amazing way in 40 years. They now have the ability to build much smaller reactors that aren't anywhere near as dangerous as the stuff that was built, 40, 50 years ago. And so I think this is a great thing. I think this is a great thing. I'm all in. Hey, let's build more nuclear. Let's add some more power. Let's build new. And the other thing is that the existing nuclear power plants that we have, these things are getting old, man. A lot of these things are 40, 45, 50 years old, maybe even 55 years old. And a lot of the useful life on these power plants is probably between 80 to 90 years. That's probably about as much as you're going to get out of them. So I think we need to build a lot more nuclear. I think we need to rebuild a lot of the plants that we currently have. So that's my thought. So again, I thought this was interesting. Good stuff here. So let's keep rolling along here. So, okay. This is kind of an interesting article here. So this is executive orders chart new policies for community banks. I just want to look at this real quick here. So community development, financial institutions. So there's kind of an executive order that came in around CDFIs. I've talked about that a little bit. Trade and tariffs, agency restructuring, secure payments of American benefits. So there are, so basically, the ICBA here is just encouraging community banks to communicate with their customers about safety, soundness, and security of our institutions and keep them informed of new developments and deadlines. So as the community banking industry navigates the ebbs and flows of monetary and fiscal policy changes and reorganizations within the federal government. So again, just, kind of just, like I said, interesting thing to note here as I point that out. Supreme Court just made it easier to sue an employer. So the Supreme Court lowers the bar for majority groups to sue for discrimination. Employers should review anti-discrimination policies and ensure equal treatment. Companies face increased risk of lawsuits related to DEI practices. Yes, I would say absolutely so. I've tried to kind of stay away from the whole DEI thing. It's I know that it kind of ruffles a lot of people's feathers and stuff like that. I just leave it at a simple thing. I'm not a fan of DEI. I don't like DEI policies. I think DEI policies have done a lot of harm and a lot of damage, and I think that they're going to be on their way out the door, whether people like it or not. Okay. This is interesting. New FICO credit scores incorporate buy now, pay later transactions. So FICO launched 2 credit scores that incorporate consumers' records of paying buy now, pay later loans, the analytics company said Monday. The move allows lenders to get a better sense of borrowers' repayment history, FICO said. Buy now, pay later providers have historically not had a consistent approach to reporting clients' payment history to credit reporting agencies, experts have said. Now, again, this is FICO. So this is just the company that provides the credit score. So they provide the credit score, which is, trademark and licensed to the 3 major credit bureau agencies. So in other words, Experian, Equifax, TransUnion, they use the FICO score, which is licensed from FICO. Now, FICO is saying that they have incorporated, buy now, pay later into their score, but they don't really say in this article, like when this is going to happen, if it's already happened already. Again, I have certainly not heard anything. This is the first I'm hearing of this. I have not heard that this has been incorporated into credit reports. I look at credit reports every week. I have not seen anything new or not seen anything on any credit reports out there. So this is kind of interesting to me. So hopefully keep an eye on this and see what happens here with this. MasterCard is going to join with Fiserv to promote new stablecoin. So this, again, very interesting. So MasterCard said it was expanding its relationship with Fiserv to promote the financial tech company's planned stablecoin FIUSD. So Fiserv announced yesterday it expects to have FIUSD available by the end of this year. The 2 companies explained they hope to expand stablecoin adoption. So obviously Fiserv sees a lot of big things on the horizon. Obviously Fiserv is the core system provider for hundreds, if not maybe even thousands of banks across the United States. So obviously they're going to gear up big time in the anticipation that a lot of banks are going to want to start dabbling in, stablecoin, and basically they're going to they're throwing their hat in here to basically say, hey, we're going to offer, not only are we going to help banks do this, we're going to offer them our own stable coin, and MasterCard is going to get in on it with us. So very interesting stuff here. Big banks worry about being Trump's next target, race to appease Republicans. So again, this kind of falls into some of the DEI stuff. But Texas and Oklahoma have banned some banks from state contracts, saying they discriminate against the gun and fossil fuel industries. So big banks are trying to get out of the crosshairs of Republican states, cracking down on woke policies. Banks are worried President Trump could turn the power of the federal government against them with an executive order on debanking. Banks have met with officials in states, including Texas and Oklahoma, to defend against allegations of boycotting certain industries. So, yeah, I think big banks should be very worried about this because they brought this on themselves. They've done a lot of stupid things, in my opinion. In my humble opinion, I'll say, I think they have done some very stupid things. I think they have wronged people in a number of ways. And they should be concerned about this. I'm not saying that anything will or will not necessarily happen to them, but I think that depends on how they handle things going forward. I think if they, just run their shop and stay clear of some of this stuff, I think they'll be fine. If they continue to double down on and continue to do some of the things that they've done, they might get whacked. So meaning whacked with regular with penalties, lawsuits, things like that, not whacked like Goodfellas. We're not taking it that far. Okay. And I just got a couple more articles here, and then we're going to wrap up here in just a few minutes. But this article was guess how much time many investors spend on researching stock buys. It's a lot less than you think and a lot less than is probably wise. So effectively, most investors spend roughly 6 minutes. And note that, the median investor often drawn to a stock because it's in the news spends just 6 minutes of research before buying that stock, according to a new study by finance professors Tumas Lauridis and Jeffrey Wergler at New York University Stern School of Business. And the bulk of that already short research time is devoted to pursuing a price chart of the stock's recent performance and often just the current day's trading session. Note that 6 minutes applies to the median investor and not all investors are impulsive. A minority investors do rather deep dives before trading a stock, but a much larger pool of investors spends virtually no time at all researching a stock before buying it. I would maybe venture to say that this is maybe people using the Robinhood app who are maybe spending some time on Reddit, perhaps. But let's go buy those stunk stocks. 6 minutes is in my mind is kind of ridiculous. I would say if you are a highly experienced trader and you know exactly what you're looking at, you could probably look at a stock and look at the key ratios, do a little bit of technical analysis in terms of looking at the stock charts. But the funny thing is 98% of investors out there that look at stock charts have no idea what they're looking at. They're like, oh, I see this goes up, but they don't know how to look at different things in terms of volume and resistance levels, price oscillation. They don't know how to interpret any of this stuff that's on the charts that are literally right in front of them. So again, all I'm saying is get educated, educate yourself. You're going to invest in stocks. You want to spend more than 6 minutes. I'll put it that way. You want to spend more than 6 minutes looking at a stock before you decide ultimately to invest in it. But get educated. Understand what is technical analysis? What is fundamental analysis? What are they? What are the difference between the two? Why should you use one? Is one better than the other? I don't think so. I think you should use both. I think you should look at the charts, technical analysis, but I think you should also look at the financials, fundamental analysis. Okay. And learn how to read financial statements, learn how to interpret financial statements the same way you would learn how to read a chart. You have to learn how to read those financial statements. So, but again, just another interesting thing to point out. And then finally here, I just thought this was really funny. I thought this headline was really revenge savings. Revenge savings picks up as consumers brace for economic uncertainty. I'm like, what in the world is revenge savings? That's like you're getting pissed off, all right, that's it. I'm saving another $1,000 this month. I've had it with you. It's just like, what is this revenge savings? I'm not even gonna go into this. I just thought this whole thing was just a funny, it's a funny headline, funny article. Okay. Oh, you know what? Hang on one second here. I got to show you guys one more thing. Some things that I want to look at. Where is it? No. No, I need to go. Why is this? Hold on. Bear with me. Bear with me for a second here. I had, there we go. Bingo. Okay. All right. This is a report that just came out from the Biz. So this is a Biz report concerning stable coins. So I'm going to get in. I'm going to cover this another time, but this is definitely something that I'm going to go into. This is just a piece of the report that came out. This was a special chapter in the Biz. So if anybody doesn't know, the Biz is the Bank of International Settlements, a hugely important bank in the global scheme of things. The Biz's annual economic report for 2025, the global institution says, so this was a chapter that was focused on the effects that stable coins could have on the economy, which is highly important. So I'm going to do a whole episode just on this to give it its due. But the full report is actually, I think, coming out next week. So I also want to get the full report too to take a look at it. So we're going to look at that, and then also we're going to break down this. So the CFPB, they put out, this is a number of credit invisible, greatly overestimated. So they made a technical correction here on this report and an update to the CFPB's what they call credit invisibles. So the so the CFPB Bureau decreased its December 2010 the number of credit invisible adults, those who have no credit history with a nationwide consumer reporting agency or who lack enough credit history to obtain credit in general. So two very interesting reports that I'm going to get into, and I'll share with you guys in another episode. But like I said, so now let's wrap up. So I wrap up every episode, or every live stream, I should say. I do a story of the week, and I basically do a quote of the week. So I want to get up my quote of the week here. First, I say before they did, I always like to end with the quote of the week. Let's do the story of the week. So the story of the week, I thought this was great this week. So June 23rd, 1836, with the U.S. national debt eliminated and the federal budget running a huge surplus, President Andrew Jackson's plan to distribute it to the states was enacted. Jackson repeatedly declared that with no more national debt, the U.S. will always have a budget surplus. So Andrew Jackson, the last president of the United States to fully pay off the national debt. What a day that was. I can't imagine how wonderful that a feeling that must have been. June 23rd, 1836. So Andrew Jackson did two amazing things in his presidency. He paid off the national debt, and he got rid of the second bank of the United States, which was the central bank at that time. So he basically killed the central bank. He paid off the national debt. And you know what happened? He set up the United States for 50 years, half a century of growth and prosperity by doing those two things. So if you don't know anything about Andrew Jackson, I highly recommend you go back and read him. He was a highly entertaining individual. He was a national hero. He's the hero of the Battle of New Orleans during the War of 1812. He fought in the American Revolution at only 14 years old while losing his mother and his brother. Absolutely amazing individual. One of my favorite presidents. And Andrew Jackson was a populist. They used to call the people all of his people were called Jacksonians. Might remind you of a certain president who's in office right now. Very, very interesting. They share a lot of similarities between those two, even though Andrew Jackson was a Democrat and our current president is a Republican. But very interesting. Andrew Jackson was known as Old Hickory, and he was one of the most popular presidents we've ever had. So that is the story of the week. Now our quote of the week. So, and this is one of my favorite quotes. So, watch your thoughts. They become words. Watch your words. They become actions. Watch your actions. They become habits. Watch your habits. They become your character. Watch your character. It becomes your destiny. Now that is that is unknown. We don't know who it was that quote is attributed to, but it is one of my favorite quotes. You gotta, there's, everything goes in a cycle there. Watch your thoughts, watch your words, watch your actions, watch your habits, watch your character. All those things ultimately will become your destiny in life. So words to live by. So, okay. With that, I will bid everyone a fond farewell. Just a note: next week, the live stream will I will do the live stream. It's actually going to be on Sunday, probably on Sunday afternoon, probably around like 1 o'clock, 2 o'clock, somewhere in that neighborhood. So keep an eye out for that. So I will be back next week, not at the normal time. It's going to be on Sunday because I've got some travel and some other things going on this week. But after next week, coming back like I said, for the foreseeable future, all throughout the rest of the summer, shouldn't have any problems doing our normal time on Saturday night at 8 o'clock. So, and like I said, a lot of great stuff coming out. Do not miss the interview with Dr. Thomas Honig next week, former Fed governor, subject of the Lord of Easy Money. If you haven't seen the Lord of Easy Money series, go check that out. So watch out for that interview next week. It's going to be a major, major interview. And then also in 2 weeks, book week. Check that out. I think people will really enjoy those episodes on the 5 characters and the 5 books that I selected. But with that, I hope everyone has a great week out there. Have a great 4th of July. Check out all the episodes that come out this week, and I will see everybody again next week. And don't forget to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below, as I always love getting back to everybody. And always check out some of the other content on the channel. But I hope everyone has a great weekend out there. Have a great upcoming week, and I will see everyone again real soon. Thanks a lot.